My name is Bill Whitehurst. The name of my business brokerage practice, Whitehurst Mergers and Acquisitions, is headquartered in Dallas, Texas. My core activity is representing business owners and selling their companies. At the time of this video, which is in mid-2013, a couple of factors have come up in the merger and acquisition market that would affect business owners, most business owners, in selling their companies. I want to talk about two of those issues today and what business owners can perhaps do about these issues prior to entering the market or prior to thinking about selling their company. One issue for a business owner in selling their company is what is called customer concentration. That is the old adage, if you will, of having all of your eggs in one basket. That is when there is a customer in a business that is a large customer that represents 25% or more of their overall sales activity. That's what banks, buyers, call customer concentration. Banks, to give a loan for the buyer to be able to buy the business, for the seller to get the money at closing, banks are looking at several ratios, for example, debt service to cash flow of the business, in which to enable them to make a loan. Banks would say, okay, what will happen if suddenly our buyer, the new owner, loses that one customer that has, say, 35% of the business? Banks have to look at the ratios without that customer being present to be able to see what the effect would be on the cash flow of the business. And in many instances, the one big customer represents such an amount of, if you will, sales profit concentration that will not enable a seller to sell that business. The issue, or the way to reconcile this issue, is for the customer not to enter the market, but to be able to get more customers in which the percentage of the effect of that one concentration goes down, say down to 15%. I've seen concentrations as high as 20% still go in today's market. But when that customer concentration gets, say, much above 25%, a few things can be done, but all of those are not good things for the seller and selling their business. Another issue that has come up this year is the effect of businesses that are either flat in sales in the last several years or declining just a little bit, say 3%, 5% a year. Certainly understandable and customary that some businesses will have an off year in which their sales are 5% less, say, than 2012. But in today's lending market, as tight as or tough as today's lending market is, banks will look at the sales activity or the sales trend of the business and say, well, if the business went down 3% in 2011, another 3% in 2012, and it looks like the trend's coming up. In 5 years, our new customer, the buyer for the business, will be strapped to be able to make payments on the loan. The way to reconcile that is for sellers to get busy, to get their negative trends, even so small, back up to where they're showing a little bit of an increase, 3 to 5% of an increase per year, and say the 2 years prior to selling. So in today's market, because of the credit crisis, the banking strict guidelines, customer concentration issues, negative sales trends can be overcome. But the main point being that the business owner needs to handle and be aware of these issues and handle them in the 2 years prior to the sale or entering the market to sell their business. My name is Bill Whitehurst, Whitehurst Mergers and Acquisitions, and I'm in Dallas, Texas.